private credit is the hottest corner of finance you've never seen. By 2023, it surpassed $2 trillion, mostly invisible to public markets, with no daily pricing, no central exchange, and no real-time transparency. It's pitched as stable, predictable, immune to volatility. But behind the curtain is a system that's never been truly tested, and where even JPMorgan can't get a trade done. Every month, JPMorgan's traders send out lists of private loans they want to buy. Serious demand, billions in firepower, but almost no one sells. Not because the loans are worthless, but because the market's power players refuse to mark the real price. If these loans start trading openly, the illusion breaks. Volatility arrives, valuations fall, confidence cracks. And that's exactly what private credit firms fear most. Because these assets are marked to model, not to market. Valuations are built on assumptions. Optimism, discretion. When stress hits, those assumptions can collapse. Regulators have warned stale pricing creates first-mover advantage. If redemptions open, the first investors out escape at inflated values, while the rest get stuck with tomorrow's losses. And liquidity? Almost non-existent. Private loans don't trade. They're long-term, bespoke deals held by a closed network of lenders. Exit early, and you're taking a massive discount, if you can exit at all. This worked when investors were institutions, pensions, insurers, sovereign funds. But now private credit is being sold to the public through interval funds, evergreen vehicles, slick fintech platforms promising yield with monthly access. But when redemption requests spike, like they did at Blackstone's $50 billion retail-focused fund in 2022, the illusion cracks. Blackstone hit its 5% quarterly withdrawal limit. It chose to honor all redemptions to avoid panic. But the signal was clear. These aren't mutual funds. When too many people want out, the gates go up and the exits close. That's how run risk enters a system that was never designed for runs. And what about the borrowers? Private credit mostly lends to mid-sized, highly leveraged companies, often backed by private equity. Their loans are floating rate, which means the surge in interest rates since 2022 has crushed interest coverage. By 2023, the average borrower was earning just 2 times their interest payments. That's a thin margin. One bad quarter, and you're restructuring. And this is all before defaults have even started climbing. If the cycle turns, or if stagflation sticks, these borrowers could fall in waves. And when losses finally get recognized, fund NAVs drop, bank lines tighten, lending stops. And the companies relying on this capital, thousands of them, get cut off. It's not just valuation and liquidity, it's concentration. By 2023, the top 10 managers raised over half the capital in global private debt. Most of it was lent to companies owned by the same set of private equity sponsors. That means multiple funds with billions in exposure are tied to the same sponsors, and sometimes the same sectors. If one sponsor runs into trouble, say a tech downturn hits their portfolio, dozens of loans across multiple funds could go bad at once. So risk that looks diversified on paper, it's actually pooled and highly correlated. And this entire market lives in the shadows of regulation. Private credit funds operate outside the rules banks, and mutual funds follow. There's no centralized data, no stress test coverage, no unified oversight. Meanwhile, banks are increasingly entangled, partnering with credit funds, offering leverage, and even transferring risk to them synthetically. In a downturn, those links can snap and bounce the shock back into the banking system. History has warned us. The subprime collapse, the leveraged loan freeze of 2008, commercial mortgage wipeouts, junk bond crashes. They all shared the same DNA: illiquid credit, stale pricing, overly optimistic assumptions, and a sudden loss of confidence. Private credit combines all of them. And while default rates remain low today, every major institution, from the BIS to the IMF, is sounding the alarm. This market is macro-critical. It's not a question of whether stress will come. It's a question of when, and whether this opaque, untested system can withstand it. This is Global Notes by JP. Subscribe for more on the markets most people don't see coming. And ask yourself, what happens when these assets are finally marked to market?